welcome back to the channel. Today, we re-diving into a topic that can seem super intimidating, but is actually one of the most powerful tools you have for building a better financial future. Investing. I know! When you hear the word investing, you might picture Wall Street traders in expensive suits yelling into phones. Or maybe complicated charts with squiggly lines that look like a heart monitor. But trust me, it's not nearly as complicated as it seems. And you definitely don't need a finance degree to get started. So, what is investing, really? At its core, investing is simply making your money work for you. Instead of just letting your cash sit in a savings account where it barely grows, you put it into assets that have the potential to increase in value over time. Think of it like planting a tree. You start with a small seed, your initial investment. You water it and give it sunlight. That's you adding more money over time. And eventually, that seed grows into a big, strong tree that provides shade and maybe even fruit. Your investments work in a similar way, growing your initial capital into a much larger sum. Now, you might be thinking, okay, that sounds nice, but isn't it risky? What if I lose all my money? And that's a totally valid question. Yes, all investing involves some level of risk. The value of your investments can go up, but they can also go down. But here's the key. Not investing is also a risk. Because of something called inflation, the tendency for the prices of goods and services to rise over time, the money you have stashed under your mattress or in a low-interest savings account is actually losing its purchasing power every single day. The $100 you have today won't buy you as much stuff 10 years from now. Investing is your best defense against inflation, giving your money the chance to grow faster than prices are rising.
The real secret to successful investing is you aren't about timing the market or picking the one.
Hot stock? That is going to explode. It's about time. Asterisk and asterisk the market. It's about consistency. And it all comes down to a magical concept called compound interest. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. Compounding is when the returns your investment earns start earning their own returns.
It creates a snowball effect.
Let's break it down with a simple example. Imagine you invest $1,000 and it earns a 10% return in the first year. Great! You now have $1,100. The next year, if you earn another 10%, you're not just earning it on your original $1,000. You're earning it on the full $1,100. So you make $110, bringing your total to $1,210. It might not seem like much at first, but over decades, this effect becomes incredibly powerful. That's why the best time to start investing was yesterday, and the second best time is right now. The earlier you start, the more time you give your money to compound and grow. Okay, so you're sold on the why. Now, for the how. Where do you actually put your money? There are a ton of options out there, but let's talk about some of the most common and beginner-friendly ones. First up, we have stocks. When you buy a stock, you're buying a tiny piece of ownership in a public company. If the company does well, the value of your piece or share can go up. If it does poorly, it can go down. Buying individual stocks can be exciting, but it also carries higher risk because your fortune is tied to a single company. This brings us to a much safer approach for beginners. Diversification. You've heard the saying, don't put all your eggs in one basket. That's the core idea here. Instead of betting on just one company, you spread your money across many different companies, industries, and even countries. So, if one of your investments isn't doing so well, the others can help balance it out. and the easiest way to diversify index funds and ETFs or exchange-traded funds. Think of an index fund as a big basket that holds stocks of hundreds or even thousands of different companies. For example, an S&P 500 index fund holds small pieces of the 500 largest companies in the United States. When you buy a share of that fund, you're instantly diversified across all those companies. You're not trying to pick winners. You're just betting on the overall growth of the market, which historically has always trended upwards over the long term.
ETFs are very similar to index funds, but trade on the stock exchange just like individual stocks, making them super easy to buy and sell.
For most people, just starting out, a simple, low-cost index fund or ETF is the perfect place to begin. Another option you might hear about is bonds. Bonds are essentially loans you make to a government or a corporation. In return for your loan, they promise to pay you back the principal amount plus regular interest payments over a set period. Bonds are generally considered safer than stocks, but they also typically offer lower returns. They're a great way to add some stability to your investment portfolio. So, how do you actually buy these things? You'll need to open an investment account with a brokerage. Don't worry, this is way easier than it sounds. There are tons of online brokerages out there today with user-friendly apps that let you open an account in minutes right from your phone. Many of them have no account minimums and offer commission-free trading, which means you can get started with as little as $5 or $10. Once your account is open, the strategy is simple. Contribute regularly and be patient. This is a concept called dollar cost averaging. Instead of trying to dump a huge pile of cash into the market at the perfect time, which is impossible to predict by the way you invest a fixed amount of money at regular intervals, say $50 every month. When the market is high, your $50 buys fewer shares. When the market is low, your same $50 buys more shares. Over time, this averages out your purchase price and reduces the risk of investing a large sum right before a market dip. It takes the emotion and guesswork out of it. Just set it and forget it. The biggest mistake new investors make is panicking. The market will have bad days, bad weeks, and even bad years. It's a natural part of the cycle. You'll see your account value drop, and your first instinct might be to sell everything to stop the bleeding. Resist that urge. History has shown time and time again that the market always recovers. Selling during a downturn just locks in your losses. The people who truly build wealth are the ones who stay the course, who keep investing their regular amounts even when things look scary, and who have the patience to wait for the recovery. Remember, you're in this for the long haul. Think in terms of decades, not days. Your mindset is your most important asset. Think of yourself as a business owner, not a gambler. You are methodically accumulating assets that will generate wealth for you over time. Don't check your portfolio every day. It will only stress you out and tempt you to make emotional decisions. Maybe check it once a month or even once a quarter. Focus on what you can control: your savings rate, your consistency, and your patience. Let's recap the simple 3-step plan to get started. Step 1. Open a brokerage account. Choose a reputable, low-cost provider. Step 2. Set up an automatic transfer and invest in a broad, low-cost index fund or ETF. Start with an amount you're comfortable with, even if it's small. Step 3. Be patient and stay consistent.
Let compound interest do its magic over the long term and do UNT panic when the market gets bumpy. That's really it.
That's the foundation of successful long-term investing. It's not about being a genius or getting lucky. It's It's about discipline, patience, and understanding a few simple principles. You have the power to take control of your financial destiny, and it starts today. You can absolutely do this! Thanks so much for watching. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on personal finance and building wealth. Let me know in the comments if you have any questions or what investing topics you'd like me to cover next. I'll see you in the next video.